Welcome everybody to the 4D Finance channel. My name's Jeff Beers, and today I've got 4 growth stocks that I feel still have room to run in 2020. Obviously right now the market's at an all-time high. It's really hard to find growth stories that still have room to run, but I got 4 stocks here that I think qualify. Let's check them out. All right, first on the list today is a company called VMware. And what they provide is software to help you manage your cloud infrastructure. So obviously the cloud is a very popular buzzword right now. People are moving all of their business assets and applications up to the cloud through Amazon, Microsoft, Google, you name it. And VMware essentially sits in the middle of those things and provides software to help your company or your project manage what you have in the cloud and how it communicates with your other applications. They also do things in the Internet of Things, if you will, to help devices connect to each other and communicate to each other. So it's a pretty bright opportunity VMware has, and that's one of the reasons they're featured on this show here today. Looking at the stock over the past year, and VMware was at a peak somewhere in the neighborhood of $200. As recently as spring into summer of last year, it has since taken a dip, and that's a good news if you're on the value-seeking side, because right now we're down to $152. You got a PE ratio of 9.7, and a forward PE that actually goes up into 22.08. So seeing the forward PE climb a little bit does suggest that our earnings per share are not as strong. However, with a company like VMware, there's a lot of capital allocations, there's a lot of weirdness in terms of how enterprises get built, and at least all of the reviews that I read in the company quarterly reports, revenues are on the rise. So this could just be a short-term cost of doing business that's affecting that forward PE. It will require more research on your part, but I like their prospects from a sales perspective. Taking a look at the Tip Ranks top performing analysts and what they think of VMware, and right now we got a median target of 180. So guys, that's an 18% increase over today's price. You got a high analyst at $200 and then a low of 115. So again, with VMware, with the cloud, with all the things that they're doing, there is a pretty good chance that VMware still has room to run. I think the most important thing is to dig into research, figure out their revenue cycle, what is their biggest quarter, what is their lowest, see if you can make an inference from last year in that sort of May through July time when their stock shot up to $200+. Are we coming back into that time for the year? Was it a revenue cycle thing? And if so, maybe get in now to make some short-term profits, or just buy for the long haul. I think VMware's got a very bright future. All right, up next on the list today is another victim of a recent price drop. That is Expedia Group. Expedia is online travel sites, an actual conglomerate of online travel sites. I've done a full review of them in the past. I really do like the prospects for Expedia Group. But what we're seeing right now with Expedia Group is they did take a little bit of a hit because there were some call outs on the Google search engine side that Google's some of their new products were causing less traffic to go to all the other travel sites, including Expedia. So there's a little bit of a travel scare in there. It does look like some of those fears are real, but at the same token, there's still plenty of room to grow with Expedia. They have their hands in so many aspects of travel, including that sort of new rent by owner model. They've had a site for a long time, VRBO. RVO that plays in that same space. All right, looking at where Expedia stock stands today, got a current price of 111. That's down from a high in the 140s that happened, let's see, as recently as last fall. So you're not too far away from a high point of 140, 145. We're down to 111. Current PE ratio is 33.26. And I did not put the forward PE on this board, but it's in and around $15. So unlike VMware, we're actually seeing a forward PE that's coming down, actually quite significantly heading into next quarter or the next projected 12 months. So this is good news for Expedia, and I think the crash that we've seen here might actually be time, if you're interested in the travel industry, to take a look at it. All right, so on the tip rank side of things, as far as the best performing analysts, we have a median price target of $132.57 for Expedia, so that's about 20 bucks up from where we stand today. The high bar is 172 and the low bar is 100. So again, this is projected over the next 12 months by the top performing analysts and tip ranks. They're saying there's plenty of room to run in Expedia. Frankly, I think travel is still going pretty strong. I think that a lot of people are replacing buying things with buying experiences. And the fact that Expedia still has room to grow in the rental by owner space that's becoming so popular, I really like them across the board. Just do your own research and make sure that you have a good feeling of where travel revenues will go into this next year. All right, number 3 on the list is a retail company, Five Below. Five Below is a chain of discount stores where the price is $5 and below on every item they have. We actually have a couple of them here in Cincinnati. They're very nice stores considering their merchants or their merchandise and their price point. I actually like taking my kids to Five Below because they can find little crafts and stuff like that they like to do on a rainy day. So I have been a shopper at these stores. They're very nice and clean. I think that they're an interesting rival to a Dollar Tree or a Dollar General. They don't have as many wide-ranging products that you see as far as like ton of houseware type entities. It's more like shiny objects at a Five Below. But I think it's a good destination site and probably the right place to be in retail. From a stock perspective, we got a current price of $115. That's actually down from about $145 around this time last year into spring a little bit. And what happened here recently is Five Below had an earnings disappointment, so to speak, when they came out with last quarter's earnings. So their stock did take a little bit of a hit. So it could be a prime time to try to pick some up if you are interested and make some quick turnaround profits. I think the long-term story here is good. You have a PE ratio right now of 41.97. The forward PE drops to 32.47, so a little bit higher than some of the other stocks, and the fact that some retail is a bit of a downer for me. But if anything's going to succeed in retail, I think it's companies like these, specialty stores, especially ones that are high on the discount side. That's exactly what you have with Five Below. All right, taking a look at the tip rank analysts, we got a median price target of up 13% to $129.88. You have a high bar of $149 and a low of $110. So basically, there's an opportunity here on a recent dip. If Five Below even just ekes their way back up to where they stood, say, 3 months ago, then it could be a quick profit for you if you're interested. I personally don't play the retail space a whole lot. However, if I was going to, I stick in the discount side. So I am an owner of TJ Maxx stock, for example. But this could go right along there with it. So keep your eyes out for Five Below. All right, last on our list of growth stocks with room to run, we have LiveRamp. And what LiveRamp does is they are an identity match company for marketing applications. I'm very familiar with it from digital marketing. Basically, what LiveRamp does is it takes your existing consumer database or email list or whatever information you have, and they can match that data anonymously. And what this allows marketers to do is understand more about their current customers and also be able to safely and anonymously identify other customers to market to. So it saves marketers a ton of money to get these insights and basically replaces some of the research methods that marketers used to have in the past, like case studies or panels and stuff like that, who likes this and why. You can get a lot of that information through partners like LiveRamp, and they've got a pretty strong hold on the market right now. So I like the direction that they're going. When you look at the stock from today's perspective at $44.92, that is a little bit off of its recent high in the $50 range. But if you go all the way back to the early parts of last year, you are trending in a $60, $61 range, which means that here at 45, we still have room to run. They made an acquisition at I don't know, it's about 6 months ago, I guess I'd call it. They made another acquisition with a data company to bring even more data real estate into their mix. So my guess is right now the PE ratio, which doesn't exist, I'm guessing that they have some capital expenditure as far as the acquisition is concerned. So we have no PE today, a forward PE of 178, which is obviously extremely high. But you're coming in at a time at the end of an acquisition. 6 months ago is pretty good because that means that the revenue from that acquisition should take place prior to the end of 2020. That's pure speculation on my part, but just in my history and knowing what I know about the company, the data integration should be pretty fast, and I would expect to see them fully integrated with the useful features of that acquisition by Q4 of 2020, if not Q3, because that's when all the marketers are going to want those new shiny objects. All right, for targets for LiveRamp from the TipRanks dashboard, you got a median target of $64. That's a 42% increase, guys. So very promising on that front. You also have a high of 67 and a low of 61. So the analysts are just as high as I am about LiveRamp. There is some risk though, because you're coming off of a time where a formerly profitable company has made an outlay for an acquisition, and so they're going to miss a few quarters, I guess you could say, of pure profitability. But I think at the end of the day, this is a winner for the long term, and I expect the price to be up from where it is today by the end of the year. All right, so there we have it, guys. 4 growth stocks that still have room to run. It's very hard to find easy growth stories right now that have not already been priced into stock prices. So that kind of leaves you a couple options, right? You can dig hard like I did to come up with stocks like this, or as I will actually practice, I'm just keeping my money off to the side. I don't think the stock market's going to be in a full collapse mode this year, but I do expect to see the normal dips and valleys, and that'll be the next time I jump in. Hope you guys enjoyed this. Please give me a like and subscribe, and we'll see you on the next video.